Okay, well, good evening and welcome everybody to this introduction to beginner's guide to investing with the legend that is Paul Correa, who joins us from Gibraltar tonight from Fiduciary Wealth Management. Paul, how are you this evening?
Absolutely smashing. Thank you, Carl. Pleasure to be here.
Good to see you. So we will go into who you are and what you do for people, and we'll spend half an hour or so on the public recording, and we will go to a bit of a hands-up Q&A lock-in afterwards, where we'll talk about the broader aspects, I think, of economics and economists. I often get those hard to pronounce, as you probably do as well, Paul. But we'll broaden the discussion into economics afterwards and how investment relates to that, and the rather tumultuous times we're living in that regard. But in the first part, let's find out who you are and what you do for people. Let's find out about your particular strategy, your approach to investment. And I think we might be able to eke a few tips out of you tonight, as we often are in this sort of situation. Am I right?
Absolutely.
Good.
So who are we? We are a wealth management practice, which was established in 2007, serving the expatriate community. We provide, key service. We offer a very diverse range of services, but in a nutshell, what we do is we provide tax optimized wealth management advice to the expatriate community, and our clients are typically retirees, individuals who are either planning to or who have moved permanently from another country in search of a better quality of life. We help C-level executives in active employment that are holding senior management positions with a high earning capacity and building considerable wealth during their lifetime. And then lastly, we help wealthy individuals with global business interests where residency, domicile, and location of wealth generation causes cross-border conflict. Just a bit of background of our links and ties. We are closely associated with the oldest law firm in Gibraltar called Isolas. It's the longest standing Band 1 law firm, and it was founded in 1892. So it has a long history. And then equally, we are proud of being admitted into a global accountancy network called MGI Worldwide. We are the member firm representing Gibraltar within this global network of accountants, tax, legal, and consulting firms. It's a top 20 ranked network. So I think it's currently ranked at 16th, and it has 10,000 professionals in 380 locations, 100 countries, and it drives close to 1 trillion in revenue. Sorry, I should say that again. 1 billion, I should say, sorry. 1 billion in revenue. I wish it was 1 trillion.
That was the forecast. That was the
forecast.
Yeah,
that's the 3-year forecast. No, it's 1 billion, close to $1 billion in revenue. So we've got legal roots and accountancy roots, but essentially our business is all about relocating individuals, tax optimization, investment management, retirement planning, cross-border financial planning. Most of our clients, not all of them, but most of them are Brits.
Okay, excellent. Thank you very much. And we should add tonight, we're not giving financial advice. We're talking about investment rather than giving specific tips. Always check with a financial expert before you make decisions and part with your money. But it should prove to be an interesting discussion nonetheless. Now, a lot of people want to make money fast with this. I guess you get that all the time, Paul. The impatience that people have two things, I suppose, and they might be contradictory. To have their money very safe and to make a stack at the same time. Now, I know you're not a short-termist. Tell us about your strategy.
Well, that's a very good point to raise. I mean, you're absolutely right. I think everyone has most investors are risk averse, but with high return expectations. And we get it all the time. And we've had it particularly the last 3 or 4 months, even our own clients, with, what's happening to precious metals and it's not going up. Well, it doesn't go up in a straight line. You have to have a long-term mindset. You have to have a tolerance to risk. You have to take a bit of risk or endure a bit of short-term pain to make a long-term gain. It just works like that, And if you haven't got the 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 ability to endure that pain, then you should be in cash. It's as simple as that. There's no two ways around it. But look, our strategy is always the same. We are macro economists. We look at the economy. We look at markets from a macroeconomic perspective. And as we were discussing before we went live on the program, particularly in this market, which is highly manipulated, I think, there's a big divergence between economics and economies and financial markets. They are completely diverged. And, I don't see that changing so long as there's all this quantitative easing and, interest rates suppressed at zero and so forth. So no, we always take a macroeconomic view, and we look at assets and we value them relative to history. In fact, I've got a report here that, it's on precious metals, which is a 20-page research note, which I'm happy, once it's proofread and ready to go, I'm happy to share with people if they send their email addresses and their details. We can share that information. And Excellent. Look, there's interesting bits. For example, I'll give you one example, which I have here with me. I'm going back to 1970. This is a 50-year graph, and it shows the level of the US money supply as measured by M2 is one of the measures of money supply, and then the price of gold, because historically, over time, there's always peaks and troughs. There's always periods where it overshoots or undershoots, but historically, there's always been a strong correlation, and inevitably they go back to the mean. Yeah. Sorry, I haven't got it here in front of me, but basically what it is, we're looking at the money supply now, and it's grown so much in the US recently that the gold price should be at 2,500 based on the amount of money in circulation in the US economy. 2,500, and as you know, is just breaking as we speak the 1,800 barrier. Yeah. So there's still a long way to go, and we're very patient. And remember, the price of the underlying commodity might be, 30-40% down on its fair value, but the gold miners are always a leverage on the underlying price of the commodity being gold. So and sometimes it's twice, if it's a senior or mid-tier gold miner, or if it's a junior miner where it carries more risk, it's 3-4 times leverage. So if I'm saying that the gold is 40% undervalued, the miners have potential to go up 120%. But we have to be patient. And then silver is even more volatile than junior miners. So the potential is enormous. But we have to wait. We've seen, and I say it in the report, we've seen what we've seen recently is gold completely out of favor. We've seen a sharp sell-off in recent months because the Federal Reserve, there's noise that the Federal Reserve is going to tighten interest rates or raise rates and, start taper quantitative easing. So these things are very negative. And there's been heavy bouts of gold futures selling by short-term speculators. And often they are 25 times leveraged. 25 times leverage, and they are the ones dominating short-term price movements and pushing prices lower. Now, the good thing is that speculators can be easily overpowered once capital flows back into gold and silver, and and sentiment changes in the marketplace. And because they are leveraged so heavily, 25 times, a shift of 4% in the gold price upwards can wipe them out completely. So they haven't got unlimited firepower, but it's these short-term speculators that have been driving the price down. And so long as capital doesn't flow into gold and silver, they just drive it lower. But I think we're starting to see in the last few days a changing trend.
That fresh, eh? Scott in the comments is saying gold is manipulated. I think there are a few people with you and your view here tonight, and keen to know what you're going to say this evening. And we will go into that bigger economic picture in the hands up Q&A after the main event here. My current strategy, says Jeff, is to hold the gold. Yeah, hold the gold. It's a nice little phrase there, isn't it? My current strategy is to hold gold until QE ceases. So more talk of that later on, because I want to get the general picture of how you go about things and how you would advise somebody. Well, I say advise. What tips you would give? You know what? You know the line I'm trying to walk here. We're talking about the beginner's guide to investment for expats, and we're giving some tips on what people might look out for, what they might be aware of. What else can you say then? We talked about the long-term view there, Paul, and how important that is. And this is not a discussion tonight about short-term gains. You can go elsewhere for that sort of thing. Yours is a longer-term strategy. What else are you saying to the expat investor who wants to try their arm at this?
Sorry, just a second. I was trying to access the report unsuccessfully.
The incoming gold prices, I suspect.
Yeah, well, what we tell investors is what we're telling them, have a long-term mindset, remain calm, remain positive, look at the bigger picture, have a bit of faith that we buy assets which are undervalued, because, you can follow the herd or you can take a different road, yeah? And the herd is normally driven by greed. And, and when prices go down, fear takes over. And, if you look at, as I said, gold and silver, it is so undervalued relative to the US money supply, which, whatever they say, look, even if they are to taper quantitative easing, which they say they might start in November, December at a rate of 15 billion a month, and they stick to that timeline, which ends in June 2022. Even if they do that, that would be another $660 billion of quantitative easing into the monetary system. And trust me, I am still not convinced that they can taper and raise rates at the same time. In fact, I am very convinced, because the Fed is sadly trapped, like most central banks, between two evils, inflation and deflation, and they can't address both things simultaneously. So they are mutually exclusive objectives. And, the central banks have, one goal. Their mandate is stable prices and full employment. That's what they're employed. But in this market where they've had to tamper, with the natural laws, I think we spoke about it yesterday during our radio show. You tamper with natural laws and then you don't know what the consequences are. The fact is, the law of gravity, the apple falls down on the ground, right? You start tampering with natural laws and then the outcome is unknown. And what we have now, which is hyperinflation, because, we talk about, and again, on the report I mentioned, we talk about, let me just cover that ground because it's quite interesting. I think your viewers will.
Well, Scott's saying, yeah, I agree. The Fed is trapped. They can't raise rates and they can't stop buying T-bills. It's stagflation, says Jeff. Says
absolutely.
A few people who know what they're talking about here.
I would
go on.
Sorry, I agree with Jeff entirely. I think, and I was going to get to that. I think what we're facing is stagflation, low growth, and hyperinflation. And I'll tell you something which in support of what Jeff is saying there, is that, we had inflation data coming out of the US yesterday, inflation consumer price index at 5.4%. Its fastest pace since 1991. But what's particularly interesting is that, the CPI is also manipulated. It depends what the constituent parts of the CPI index is. But if you ignore the index and look at what's happening, what's happening out in the street, so to speak, because I don't think that CPI is reflective of current inflationary pressures. But if you look at the US home prices as measured by the Case-Shiller National Home Price Index, it's up 19.7% in the year ending July 21. And then if you look at, and that's the highest annual increase since the index was launched in 1987. If you look at apartment rents, they're up 11.5%. We've got fuel costs, which are through the roof. Let's not forget that, oil was bottomed out in May 2020 at $11 a barrel, and it's $80 a barrel today. And by the end of the winter, I wouldn't be surprised if it breaks through 100. That is hugely inflationary. And the difference between now and then, because we need to look at, and you rightly said, you always look at it historically. Yes, I do. I think you have to put it into perspective. And the other, if we look back in time, in the 1970s, when we had that bout of inflation, and inflationary pressures took hold, the Fed chairman at the time was Volcker, and Volcker raised interest rates to double digits. The problem we have now is that raising rates, even marginal rates, would cause loan defaults and destroy the global economic system as we know it. So we repeat again, the Fed is trapped. In the 70s, they could raise rates and they, as a way of dampening inflationary pressures, but they can't do that now. They make noises and there's this rhetoric about we need to control inflation, but they have no tools. It's like, having all these ammunition to fight the enemy and you run out of bullets, right? You've got nothing.
Paul, I am struggling to keep you away from global economics here, aren't I?
Okay, fair enough.
It's a fascinating subject, and I think everybody does want to go there, and we will for sure. John, thank you for your comments, and Paula as well. We'll open that up because a lot of these things you're saying, I think you should come onto the microphone in the Q&A part and actually speak these because they're quite technical, and I think we're going to have a fascinating discussion afterwards. But I do want to bring you back to, given the picture you described there, somebody who wants to protect themselves, who wants to be an investor, what chance do they have against such forces?
Well, you have to buy hard assets, and hard assets are, property and crypto. I don't believe in crypto. I'm very vocal about that.
Hold on a minute. What you suggest people go into it, but you're not a fan yourself?
No. I'm not saying. I'm saying that some people would advocate going to real assets like crypto. Yeah. I'm very vocal of the fact that I don't believe in that, but many people do. But okay. I would buy hard assets.
The basis of which you are supportive is that it's a hard. Well, is it a hard asset?
Well, it's deemed in this environment a hard asset. Okay,
all right.
But I would buy real estate, and I would buy gold and silver, and I would buy the miners. I really would, because I think that's what is going to hold its value, and it was going to rally. Is just a question of time. I've got another graph which I'll share or I'll cover at some point when we start the Q&A, which is quite interesting.
All right. So would you agree with, Jeff is saying here, good evening to you, Jeff, by the way, borrow as much as possible at the lowest interest rates, which are available at the moment, right? And then buy the assets you're talking about. Would you see that as a useful strategy?
I think so. You're leveraging yourself, and you have to have the capacity to endure short-term loss. And I'm not suggesting, please, that you should do that. But I'm saying for those who take a long-term view and have a higher risk appetite, absolutely, I agree with Jeff 100%.
Yeah. Okay, there are a few people on the same page here. John is saying crypto for some is an alternative to gold. So I think that's on a similar wavelength to you. Paul has it right, says Scott. Inflation means buying assets and commodities. So for the record, and I'm surprised you were the first person to mention crypto tonight, because usually it's somebody else in the chat, isn't it, who comes in with crypto. What are your reservations about it?
Well, my reservations are what I've always said. Firstly, it's an unregulated market. I've had, I keep hearing that people, if you lose, because no one knows who started Bitcoin, for instance, you lose your password and you lose access to your money, right? Yeah. It's unregulated. It's used for money laundering. We know that. I think taxation is another one. Regulators are starting to ban crypto or regulate it. And those are some of my concerns, that it hasn't got an intrinsic value like, gold or silver. And we know that central banks and most of the advanced economies are keen to launch their own digital currency to compete with crypto. At some point, something will happen. Something will crack.
Okay.
So I'd rather not go into crypto, but that's a personal view and a view that is not shared by everyone.
No, understood. And that's the nature of investment, isn't it? We know that very well. I think the governments are going to do what Paul has just said, says Jeff, I think, about crypto there. And John, what do you make of this comment, Paul? One must decide, is one a trader or an investor? Both very different, need a completely different approach to investing. Are you with that?
I love that question. Who said who are?
That's John. That's John Bromwich. Your friend John Bromwich in the chat, or your new friend John Bromwich.
Okay, no, John. Well, I couldn't agree with you more, and I keep having those discussions internally within the business and our clients and so on. We're not traders that we trade in a nanosecond. I've been told, but you can trade in a nanosecond. That's not our business. We are not traders. We take, based on fundamentals, we take a long-term position, with that long-term mindset, but we're not into buying and selling. The ones that are buying and selling are the ones I referred to earlier, those that those individuals that have pushed the price of gold and silver lower during the last 3 to 6 months, because they are 25 times leveraged. They are short-term speculators using gold futures, selling gold futures to drive the price. Those are traders. I'm not a trader.
Okay.
I'm a long-term investor. So excellent point by John. I wholeheartedly agree with his analysis.
All right. Well, let's go into some of those things we might watch out for now, which people really appreciate about you, I think. And we've done this a few times now, and it's caused me to do a little bit of investing via my Revolut app. And it's on these occasions when I call it onto my phone and see what's going on there. Not looking brilliant at the moment, but I'm consoling myself with the long-term view that we've been speaking about tonight. So long-term, oh yes, Kevin Slater, just want to squeeze this into the conversation. One of the major advantages of Bitcoin is that it's not regulated. That's a fair point, isn't it? For the time being anyway, that has its advantages.
For the time being, absolutely.
For the time being, for sure. And I have to say, Portugal, especially advantageous as a place, it would seem to be a crypto sort of person. There is a legal expertise here. And at the moment, as I understand it, check for yourself, of course, capital gains through crypto are not currently taxed here in Portugal. That's a picture that will be changing all the time. But it does look like a lot of crypto-minded people are flocking towards Portugal for those reasons. Okay, so long-term, not trading, but investing. Hard assets, Paul. This is the picture we're creating. This is the mindset you want people to have, I think, if they are the expats who are thinking about.
I think, look, absolutely. I think if we look back in time at similar periods, history tells us that we're very early in a bull market, that there's still some years to run. Look, there's been 4 or 5 gold bull markets in the last century, or the last century. First one was 1930 to 1934, and in the space of 50 months, the price of gold increased 400%. Mm-hmm. Take a note of this. The second one was the one when Volcker was chairman of the Federal Reserve. And again, the price of gold went up 400%. The third one was 76 to 1980. Again, price of gold went up quite significantly, about 400%. Then we've had 2 other gold bull markets. One which was 2000 to 2011, which ended in 2011. And that one was of a longer duration. That one lasted 130 months. That was almost a 10-year bull market, 11-year bull market. And in that one, we saw the price of gold increase 600%. This one is still an early bull market. It's already run 60 months, 5 years, and it's only increased in price by 100%. Mm-hmm. So take a note of this. We're still early in the bull market. It's only gone up 100%. So if history is anything to go by in the last 100 years, anywhere between 400% and 600% is what we should expect. I think because of the amount of quantitative easing and suppression of interest rates and all the manipulation and helicopter money and so on, I think this is going to be an even greater bull market than we've seen in the past. I think it'll exceed the one from 2000 to 2012. So really? We're very, very early in. We have to be patient, but those who take the long-term mindset will benefit from having that, that ability to hold fire and just endure the volatility and take that view.
Well, what an interesting conversation we might be having on a beach in Portugal in 15 years from now. with those who may have made certain decisions tonight based on what's being said. So let's go specifically then. I mean, you're talking about hard assets. Principally, we're talking a lot about gold tonight, and I think investors who are seasoned investors and know about these things say, yeah, buy gold. But to somebody who's new to that, how do you actually do that, Paul? How does somebody who doesn't know how to do these things actually get hold of some gold and invest in that way?
Well, you can buy gold through a bank. You know, and you can, you know, you can buy gold bullion and have it in a vault,
Yes.
which is, you know, what very mega rich individuals do. I think
Like
most of us,
we've seen it in the movie.
like we've seen in the movies. I think most people now will buy an ETF, an exchange traded fund, which tracks the price of gold or silver, and just holds the assets as if it was a mutual fund. That's one option. The second possibility is that you buy the gold miners, which are a leverage on gold, or the silver miners, which have more volatility, but 3-4 times. So you can imagine, if gold is going to increase 600% and you buy the gold miners, then it's 6 times 3.
Okay,
So that's
and I need to ask you again.
1,800%.
You're a man immersed in this day to day, and you say buy the gold miners. What does that actually mean? You're talking about buying stock in those companies that are doing the mining.
Well, you buy a fund which buys companies that are gold miners and are extracting and mining gold.
Okay, a fund of mixed stock,
Yes,
then, not specific.
No, a fund that invests purely in companies that mine and produce gold, and silver, for that matter.
Yes. Okay. So with mine, because when we talked, I think a few months back, you had a particular a company of interest, which was Kinross, I think, wasn't it?
Kinross, and I mean, it's been battered like all of them, but I'm very, very Kinross, and I would say Rio Tinto, which is quoted in the FTSE 100, and, you know, extremely cheap at these levels. They're just going to go, they're going to race.
Okay, and I'm chuffed to say that my Harmony gold mining purchase has only gone down. I'm talking now, like, you know, you say they've all been battered. My pick of Harmony gold mining only went down 6.3%, which is a little bit less than the hit that Kinross took. So that's not so bad at the moment by the sound of it. But then again, I did only invest £10. So, but it was just to get an illustration, and I think this is quite a good thing. You might also recommend this. I mean, this is a great thing you can do on your app, but people can actually literally play at this, can't they, with small amounts of money? You don't have to be a red braces, great big property magnate, wheeler dealer like we've seen on the movies who buys gold bullion. You can play at this, can't you, on the web and on apps now with buying small amounts?
Yeah, of course.
And then you get the idea of how it works.
Yeah.
Yeah. Okay. So Revolut is my way of doing that. What else have you got then, Paul? We're talking about funds there with the gold miners. Anything else for us that we might be looking at?
I mean, it's a difficult one. I would say industrial metals. They've taken a pasting. Palladium has gone down. I was looking at the Bloomberg app. Let me just have a quick look again. But it's taking a big hit.
And where are you looking? Are we allowed to know where you're looking right now?
Yeah. I'm looking at the Bloomberg app, which I have on my phone.
All right. Okay.
And Palladium is down in the last year. Let me see. It's been a roller coaster ride. I think it's like copper. You know, it's heading higher, but it peaked at much higher. You know, at almost 3,000. And now and then it bottomed at 1,900 or whatever it is, and it's picking up again. It's picking up. So plenty of opportunities within the industrial metal space.
Okay. And how? Because I think we talked about chips before as well, didn't we? Obviously, silicon chips.
Yeah, semiconductors and the like, and there's a lot of areas where there's value in the market, but, you know, it's an expensive market and one has to tread carefully. I think, you know, we could have the market, the financial markets, more stimulation. It could go run into 2022, but again, you had to look at the data as it comes in, because some of the data coming in now is starting to be a bit patchy, as Jeff mentioned. I think, you know, some of the data is indicating that maybe the global economy is starting to slow down a bit, in which case the stock market might take a hit. Equally, It might keep running into 2022, but then, then it might get even more expensive and even more crazy. And then you need to take the chips off the table at some point.
To mix our chip metaphors there. Brilliant. Okay. Before we go to the hands up Q&A and turn off the recording here for the public part of the webinar, can you explain a little bit more? The ETF acronym came up on the breakfast show the other day. For people who don't know what an ETF is, and I am doing my best here to try and demystify a lot of what goes on here, because this is the beginner's guide. So what's being spoken about there with ETFs, Paul? How do they work?
Well, ETFs are unlike mutual funds where you buy the underlying companies. The ETF, what they do is they buy, they could buy futures or options, they could buy derivatives, or they might buy an index and track an index using derivatives. So it's cheap and cheerful, and so it's passive investing.
Okay.
By tracking a particular commodity, a particular asset type, rather than buying hundreds of different companies within a space. So if you buy, I don't know, if you're into UK equities, you buy a fund, and the fund might have 100 underlying UK equities, or 100, or I'm buying the US equity fund, so you're tracking 100 companies. But with ETFs, it's based on tracking an asset type, rather than buying the underlying companies. So that's the distinction, and it's much cheaper to manage. So whereas a mutual fund it's active management, an ETF is passive management, just tracking an index.
Okay, and safer in that way. What are the advantages?
Well, it depends, because some people claim, that most asset managers are, their track record is not very good, and you're better off just tracking an index than putting it in the hands of fund managers that perform worse than the index they're supposed to track. Mm-hmm. So if you're rated top quartile in the top 25% of your space, so let's say there's 1,000 UK equity funds, and you are ranked performance-wise in the top 250, then you could potentially be outperforming the UK FTSE 100. Yeah, in which case you want an active fund. So it depends on the fund manager and then how they perform. With a tracker, it's a no-brainer. You just track an index. You think, what? I don't know. Pork bellies are going to go up. I'll just buy an ETF. It's cheap. It doesn't cost too much, and I don't have to think too much of whether it's going to underperform or overperform. I think pork bellies are cheap, and I'll just buy an ETF. That's what it is in a nutshell.
I imagine very popular in Portugal as well, now you mention it.
Exactly.
Okay, so just to conclude then, Emily, thank you for this comment. And I think this happens to quite a few people, to be fair, when it comes to investing and money, generally speaking. My brain is turning into porridge trying to understand all of this. It is complex. It's complex and complicated. And sometimes you need professional help. Paul is there to do that. Is there any simple advice you can give to someone like Emily? And a lot of other people, it has to be said, who think to themselves, I know, I'm going to look into this, and then their brain does go to porridge. Is it just for a certain kind of mindset, Paul, do you think?
No, it's not for a certain mindset. The thing is, as you rightly said before, most investors have a low appetite for risk, but have super high return expectations. And unfortunately, in life, it doesn't work like that. Risk and reward go hand in hand. They are married together. So low risk, low returns, high risk, high returns, and you just have to be patient. So if someone has that long-term mindset and say, these are long-term investments for my retirement, or I can put it to one side, then it's a great time to invest. But you need to know what you're investing in, and to know the context and the reasons. For instance, if one of your listeners were to tell me what is the rationale and the argument for buying precious metals, I would tell you 6 things. I would tell you raging inflation. I would tell you easy money, because they're pumping money into the system. I would tell you negative real interest rates across the entire US yield curve, because you've got inflation at 5 and US Treasury is paying anywhere between 1.3 and 2. Yeah. Mm-hmm. So in real terms, your money is being eroded by inflation. The national debt of most countries, including the US, is growing by the hour. The monetary base is being expanded. If I look at the technical outlook, it looks increasingly bullish to me, and And then if you look at the fundamentals of most of the miners, they've got pristine balance sheets and they're making a lot of money. They're repaying their debt very quickly. So there's fundamental reasons why we're buying. We're not just waking up one morning and saying, you know what, I think this is a great investment. I think there's a lot of research and rationale that goes behind it. Yes, things can change very quickly in the market, but I'd rather be buying something which is already cheap, even if the variables change and the outlook changes. But you know, the balance, you invest on the balance of probability, right? And if you factor everything in, you can say, okay, the balance of probability, you know, it's 95% in my favor. You know, it's the same way when you go into a casino and you play cards, you know you're going to lose. And the guy knows is, you know, on a 99% probability is going to win, right? And that's what we try and do, and reduce that risk by taking that long-term view. Yeah.
What an amazing moment to end the YouTube recording on for the public part of the webinar.
And can I just repeat it one more time?
Please do, Paul.
You know, if they send you their full names and email addresses and telephone numbers, we will publish this report. Before we send it to our clients, we'll send you a copy. And it's purely based on the precious metal sector. I think it's an interesting one, and one that your readers might be interested in receiving. Yeah,
absolutely. So the email address for that, Paul, please.
Yeah,
inquiries at fwm.gi.
Absolutely. Name, surname, email, and telephone number, and we'll send across as soon as it's proofread, approved, and tidied up. You'll get a copy, which I reckon will be next week.
All right, that's fantastic. What a great offer. Thank you very much, Paul. Always fascinating to talk to you. And we will move on to a conversation now where Kevin Slater has put into the chat, as of last week, a number of the biggest tech stocks in the United States were all well below their recent all-time highs, as shown on a list on Twitter. All of them, the big names, Microsoft, Google, Apple, Tesla, Facebook, Amazon, Shopify, Twitter, and on it goes. Even Zoom that we're using tonight. We'll talk about the big picture and why that might be happening now. Thank you, Paul, so far. And we'll go to an exclusive part of the call. And remember, of course, if you become a premium member at expatsportugal.com, you get VIP treatment on the calls here, and you'll ensure your place to have a chat with Paul after the public part of the webinar. Stay tuned for that.